Welcome back to the Web3 Daily. Let's kick things off with a quick market check. Bitcoin moved sideways in the last 24 hours, still struggling to break through that 118 Kelvin level, but holding solid support underneath. Ethereum, on the other hand, showed strength up almost 5% and clearly outperforming the broader market. Dogecoin stole the show with a double-digit pump, setting the tone for the meme coin sector, which is lighting up again. But here's a heads up, this feels more like a short-term rebound after a dip, not a full-blown breakout. So if you're getting hyped, cool off a bit. Don't ape in with full size. Manage your risk. Now, let's talk about what everyone's been buzzing about straight from the US Treasury. A senior Treasury official just dropped a bomb saying the US dollar is going on-chain. That's right. In plain English, they're pushing stablecoins into the spotlight, not from private companies like USDC or Tether, but from within the government itself. And they're saying this is all part of Trump's new financial agenda. It's tied to a new bill called the Giants Act, which lays out a full legal framework for stablecoins. The message? The US is ready to take dollar dominance onto the blockchain. One official even said this would give the world faster, cheaper, and safer ways to pay in dollars online. Crypto Twitter is split. Some are hyped like the Winklevoss, twins calling this a huge step forward. Others are suspicious, warning that centralized digital dollars could end up choking out real decentralized innovation. But one thing's clear, this isn't just another stablecoin narrative. This is a state-level chess move. The US is entering the stablecoin game not as a player, but as the dealer. The implications? Massive. If this plays out, the entire landscape of chain-based finance could get rewritten. And right now, we're watching Act 1. Let's get into our first headline, and yeah, it's one of those classic SEC curveballs. Bitwise finally got the green light to convert its crypto index fund into a spot ETF. Big win, right? Well, hold up. Just hours after approval, the SEC hit pause. The same agency that just said yes suddenly said, wait, let's send this back to the full committee. It's deja vu all over again, just like what happened with Grayscale's fund a few weeks ago. Insiders say this reeks of internal tug-of-war inside the SEC. Some teams are cool with ETFs, others, not so much. Word is, this delay move might be a legal loophole to buy more time before hitting official deadlines. What Bitwise wanted to do was simple turn its BITW fund, which includes assets like Bitcoin and Ethereum, into a tradable ETF. Had this gone through, it would have been another legit on-ramp for mainstream money. But this sudden freeze throws shade. It's hard not to wonder, is the SEC still unsure whether they actually want crypto ETFs? Market didn't panic much, probably because the current trend is still bullish. But it's another reminder, even when we're close, nothing's locked in until it's live. Short term, definitely a bearish twist. Long term though, we're getting closer. Just gotta hold tight. Let's move to headline 2, and this one's from the big leagues. Citi is officially eyeing the stablecoin game. Yeah, the same Citi that's been the poster child for TradFi for decades. Now they're exploring launching their own stablecoin, and they're not shy about it. Their execs just confirmed it in an interview, and CEO Jane Fraser mentioned in an earnings call that they're going deeper into on-chain payments and digital assets. What's the play here? Simple old money wants a seat at the new table. And the timing? Perfect. The US just passed a stablecoin regulatory bill. Hong Kong's stablecoin license program starts next month. Regulators are finally opening the door, and Citi's walking through it. From what they've said, Citi probably won't go head-to-head with USDT or USDC right away. They're starting with enterprise use case payments, custody, maybe even custom-issued digital dollars for clients. Think B2B before they ever touch retail. Crypto Twitter lit up when this dropped. People are calling it the start of the institutional era of stablecoins. And they might be right. When a bank like Citi jumps in, it forces everyone else to level up better transparency, better security, more compliance. The future of stablecoins might be a three-way fight. Crypto-native projects, tech giants, and now, global banks. One thing, though, let's not get it twisted. Bank-backed stablecoins will be fully centralized, fully KYC'd, and probably freezable. It's a different beast. But no doubt this is the market growing up, and Citi's making it loud and clear. Stablecoins aren't just surviving, they're going mainstream. News number 3 is FireRand. It's all about bringing Bitcoin into real life. Jack Dorsey just confirmed it. Square has started rolling out Bitcoin payments to select merchants. That means real-world stores can now accept Bitcoin using Lightning Network low fees, instant speed, no middlemen. This isn't a demo or a beta that gets buried. Square has over 4 million terminals. Once this rollout goes wide, we're talking real, everyday BTC payments becoming mainstream. Think about it, grabbing coffee, buying snacks, paying for gas with Bitcoin, with a QR code, just like we do with mobile pay. And Lightning Network? It's the real MVP here. Fees are a joke compared to credit cards. And for low-margin businesses, that's a big deal. Of course, most merchants will probably auto-convert to fiat. Volatility's still a thing, but this is infrastructure, and once it's in place, people will build around it. Crypto Twitter's hyped. BTC Maxis are calling this a dream come true. Some merchants already posted screenshots of their first Lightning payments. Jack's not just tweeting, he's building. And this one could change everything. News 4 is a sleeper hit, and it's coming straight from the DeFi trenches. 21 shares just filed for a brand new ETF not for Bitcoin, not for Ethereum, but for Ondo. Yeah, Ondo. The token behind the RWA protocol that's bringing real-world assets like US Treasuries on-chain. The ETF's called 21 Shares Ondo Trust. It's a spot-backed ETF meaning real Ondo tokens, fully custodied by Coinbase backing every share. No derivatives, no futures, just the actual asset. And this move? Massive signal. Up until now, only the big dogs BTC and ETH got the ETF treatment. But now we've got a DeFi token tied to tokenized bonds getting the same kind of spotlight. That's wild. Ondo's whole pitch is simple. Bring yield-bearing real-world assets to crypto. People want low-risk options, especially when rates are still decent. Ondo fills that Japan now TradFi wants in. Ondo pumped hard on the news double-digit spike, volume surged, and a bunch of smart money started circling. This isn't just a win for Ondo, it's a green light for serious DeFi protocols. If you've got real-world utility and stable cash flow, you might be next on the ETF list. It's not just Bitcoin's party anymore. Headline 5 is a stealth warning shot from Korea. Their financial regulator just gave a quiet but strong nudge to local asset managers. Cut down on crypto-related exposure in your ETFs, especially those with heavy stakes in Coinbase and MicroStrategy. No official policy drop, just a verbal heads up. But in Asian markets, that kind of soft push is basically code for fix it or we will. Why? Because even though Korean funds are technically banned from holding crypto directly, they've been sidestepping that by piling into US ETFs or buying stocks with deep crypto ties. Some ETFs in Korea holding more than 14% Coinbase. That's a lot of indirect crypto exposure. This move shows Korea's regulators are still cautious. They're not trying to ban crypto, but they definitely don't want traditional finance bleeding too deep into crypto risk. Market-wise, no major price reaction, but on the fund side, this could slow down fresh money flowing into crypto-linked stocks. Not great news for Coinbase or MicroStrategy. Big picture, it's confirmation that even regulators know these ETFs are the backdoor into crypto. And when the watchdog starts slamming that door, it means crypto's already sitting at the grown-ups table. Final story today comes from India, where CoinDCX just confirmed a 44 million exploit. Here's what went down. One of their operational wallets, the kind used for liquidity across exchanges, got compromised. Hackers got in, drained the funds, and quickly moved them through Tornado Cash, bridged to Solana, and back again. Classic wash and hide playbook. But here's the keynote. User funds were touched. CoinDCX was quick to clarify. This was our internal wallet, and we're covering the full loss ourselves. They caught it fast, paused access, and looped in security pros like ZachXBT to trace the flow. Some funds have already been tracked back to Ethereum. Community reaction? Surprisingly calm, mostly because CoinDCX owned it no gaslighting, no dodging, just straight talk and responsibility. Still, it's a wake-up call. CoinDCX is India's biggest exchange by users, and even they got hit. If a hot wallet touches cross-chain liquidity, it's a soft target, and this won't be the last time we see it. Bottom line, centralized exchanges might feel safer, but if they're using hot wallets, risk is always one bad click away. That wraps up today's Web3 Daily. The charts may be sideways, but the fundamentals? Loud as ever. From governments eyeing on-chain dollars, to banks testing stablecoins, to real Bitcoin payments hitting real stores, this space is evolving fast. These aren't just headlines, they're shifts in infrastructure, policy, and capital. If you're paying attention, you'll see it. Crypto is quietly becoming the rails of tomorrow's finance. But when the game changes, the noise gets louder. So stay sharp, stay calm, and play the long game. Catch you in the next one.